So check this out. Look at this article from Yahoo Finance, which attributed this article to the Motley Fool. Regional bank that played rescuer in 2023 is now in turmoil. Oh, here we go. So apparently there's a regional bank that assisted in the breaking down of SVB Bank. Yes, the one that went under. Let's look at this article. New York Community Bancorp, this is the bank that is in trouble, played the role of rescuer during a 2023 regional banking crisis. They assisted in this crisis by purchasing some assets of the failed Signature Bank. Well, now it is experiencing some trouble of its own. Now, when you purchase assets from any particular company or business, you're looking for that asset to bring you money. So just off the first paragraph alone, did not this bank buy good assets? Were these assets that they got up off of SVB toxic? Because why would you now be in turmoil? If you're in a position to try to be a lifesaver for a failing bank, you still have to have your best interests with that of your shareholders. So why would New York Community Bancorp buy toxic assets? What's going on? Are we about to see another banking crisis? The stock of Hicksville, New York based lender initially fell 46%. I ain't talking about 4%. 46, almost 50%, almost half of the stock value was gone in one day, after it reported a surprise net loss of $252 million for the fourth quarter and announced it slashed its dividend. This bank is in trouble. In one quarter, October through December, this bank lost $252 million. What? Are they not grabbing deposits? Are they not making money off of the deposit that they have in the bank? Or did the assets that they purchased from Signature Bank go toxic on them? Because they cut their dividend. So why would you want to hold the stock now then, if you're not going to get anything from it off of the top of you losing money? You're not going to attract new stock buyers when you're in this situation. Its 37% decline for the day was the largest one-day percentage drop in the stock's history. So it made people scared. Investors are now nervous. They don't want to hold the stock, so they jump ship. Now, could we not have seen this earlier on the chart for New York Community Bancorp? Because here's the chart right here. Was the writing already on the wall? The news sent new shockwaves through the regional banking world as stocks of other mid-sized lenders, such as Valley National Corp, Bancorp, Bank United, and Western Alliance, they all fell. An index that tracks those banks ended the day down 6%. New York Community Bancorp's troubles can be traced back to how it responded to a crisis that rolled the regional banking world in 2023, just almost a year ago. Signature was one of the three sizable regional lenders that fell between March and May, triggering panic about the strength of many other mid-sized financial institutions across the U.S. NYCB's decision to absorb billions in loans seized from the fallen rival pushed the bank above an important asset threshold of $100 billion, subjecting the company to higher regulatory standards. Now, do you think NYCB was forced to take these assets? I think so. Yeah, I think Janet Yellen, Jerome Powell, and many other people within the government said, look, We're not trying to exasperate this situation, make it worse. So you're going to go ahead and take some of these assets from Signature Bank, and it will push you into a higher standard of regulatory abuse that you will have to meet. Did they have a choice? Bigger banks in the U.S. are required to set aside more capital to give them sizable buffers against future losses. Well, let's hope that New York Bancorp did that. New York Community Bancorp, let's hope that they did that. The company said it's the reason it cut its dividend and boosted the money it set aside for loan losses. Those loan losses provisions were $552 million, well above analyst estimates, a sign that credit is also deteriorating. Its deposit also dropped by 2% between the third and fourth quarters. So not only are they losing a lot of money off their loans on their books, they are also not getting new deposits. People ain't coming into the bank, opening up accounts. Quote, we took decisive actions to build capital, reinforce our balance sheet, strengthen our risk management processes, and better align ourselves with the relevant bank peers. This is what the CEO of the bank said. Okay. The bank's predicament is one faced by many regional lenders as they recover from the turmoil of 2023. What will it take to still thrive in that pocket between a colossal like JP Morgan and thousands of other tiny community banks? Do they need to consolidate and get much bigger? I.e., should New York Community Bancorp get absorbed into Bank of America, JP Morgan, one of these other conglomerate banks, to where those major banks will have a monopoly of the financial structure of the United States? Or do you want to have many tiny community banks to where if there's another crisis, all banks won't be affected? Because if you absorb and really concentrate all banks into a couple, the next banking financial crisis won't have a savior. You won't have any other banks that can absorb those losses because they've already absorbed the losses into a couple of big banks. New York Community Bank has roughly doubled in size over the last 2 years, following its December 2022 acquisition of Flagstar Bancorp and the Signature deal in 2023, which involved the purchase of $38 billion in loans and other assets from the FDIC. The NYCB deal helped the FDIC absorb some of the costs associated with those failures. By the ending of last year, you guys can see from the article, NYCB had $116 billion in assets, making it one of the country's 30 largest banks and placing it in a larger category for regulatory scrutiny as applied by the Federal Reserve. Okay, so I told you that they cut their dividend completely, but they didn't as I look at this article now, because they cut their quarterly dividend to 5 cents to where it was originally around 17 cents. So they're still getting a dividend, but it's only a nickel. Yeah, 12-cent reduction from last quarter. NYCB also did not provide guidance for how its net interest income, a critical measure of the bank's loan profitability, would do this year. They're leaving people in the dark. It did, however, give much of the components to calculate the forecast, leaving some analysts on edge. Look at the charge-offs. Charge-off rose $100 to $185 million from $1 million in a year earlier. Man, problems. When you look at the chart, it is now trading to where it was when it first absorbed all the assets from SVB Bank. Look at that. And they're just about to get a dividend, which is due on the 13th of February. And instead of it being 17 cents, it's going to be a nickel. So looking at this on the monthly chart, look at where price is in relation to where it first started trading back in 1999. Again, every stock just doesn't go up. Take a look at this. Many people want you to hold the stock for 5, 10, 15, 20 years, forever. Imagine if you bought this stock in 2000. Yeah, in 2000. Look, let me zoom in. September of 2000. October of 2000, the market was trading at $6.50 for this stock. 24 years later, it is now back at that price. 24 years later, so stock just don't go up. Understand. You should have sold this stock, what, 2-3 years later? 4 years later? Because that was the high in the market for this stock. It's been on a downward move since then. Is this bank in trouble? Are many other community banks in trouble? What other banks did it give us? Let's look at this real quick, because they did say some other banks went lower in price. Let me go and see these banks. So we have Valley National Corp, VLY. So let's look at this up real quick, see if it's going down too. Okay, it's going down, albeit not as much as NYCB is. We also have BKU. Let's look at that one real quick. How does this look? It doesn't look too good. It just looks like a stock that's trading within a massive wide range. Let's look at Western Alliance. You can tell that these stocks aren't necessarily trending higher. Something is definitely wrong within the banking industry. Give me your thoughts. Make sure you maintain the profitability, and as always, trade different.